Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist with OptionsPlay. I actually have with me today Tony Zhang, the Chief Options Strategist with OptionsPlay, and we're going to talk about a new strategy that we're going to be introducing. It's going to be called the Stock Outperformer. We're going to go through the basics of the strategy, and it's actually going to be a part of our daily play at this point in time to kick things off. And what we're looking to do is try to do a little bit more longer term strategy based off of the research that OptionsPlay puts together, and in particular, Tony is a big part of that research, and look at just buying longer term options as an alternative to doing shorter term, more speculative type trades based off of that research. So we're looking to combine the two. We have in the daily play, we have a little bit more leveraged type trades that we do day in and day out based off of the research that we put out. And now we're going to take that research and we're going to look at a little bit more longer term, less maintenance type trade, and that's going to be called the Stock Outperformer. So before I get too far along, let me say that we will be looking at some real quotes today, and they're not meant to be a recommendation. Past performance is not a guarantee of future results. Just got to put that out there. Now let's get into the agenda. So what we're going to look at doing is we're going to have a quick overview of the strategy. I'm going to give generalities of the strategy. And then Tony's going to come on and he's going to talk a little bit about the nuts and bolts of his research that he puts together week in and week out at OptionsPlay. And then I have an actual example that I put together that I actually used inside my own portfolio around the big price move in NVIDIA. Now, NVIDIA obviously was an outperformer as far as the market is concerned, but it's not really about the fact that it was profitable. And if you own some NVIDIA, you would know that at this point in time. But it's going to be about the mechanics of how that position is managed. And then we're going to leave it open for your questions. This entire presentation is going to probably take about 45 minutes, and then we'll stick around and answer a lot of questions, maybe another 10 or 15 minutes depending on the demand. So let's get right into it. Well, I guess we pause 1 second before we get into it. We have a free trial. If you are interested in OptionsPlay, you can try it for free, 30 days. All you got to do is put your phone up and scan that QR code, or you can go directly to optionsplay.com/signup. All right, the strategy. Okay, so this is just the hierarchy as far as what our outlook is for this strategy. We're going to focus on buying longer term, deep in the money option contracts. Now, what's important about this is that we have very liquid markets, or we're looking at stocks that are fairly liquid, because as you get deeper and deeper in the money, you run into situations where bid-ask spreads get a little bit wide. But we're going to try to manage that by the underlyings that we are looking to trade. We're going to go about 6 months out in time, and that's going to be dependent on what's going on in the marketplace, but that's our target. We're going to look at individual stocks and ETFs. So not only are we going to talk about stocks, we will from time to time look at certain sectors of the marketplace and look at ETFs. One of the great things about ETFs is most of them, the ones that we'll be talking about in general, are very liquid. They have very solid markets, and they're a little bit lower priced than some of the individual stocks that we have, which also means that you can buy more option contracts that track around that ETF. Because we're going to look at allocating a specific percentage of your portfolio to every position that we decide to put on. So here we go. We have deep in the money calls, and by that, how do we judge the deepness, I guess would be the question. And we're going to do that with delta. So we're going to look at about an 80 delta. Now, if you're a beginning option trader, don't let that word scare you. It just really means that you're going to get something that acts a lot like the stock. So the whole guts of this strategy is that we are going to buy an option contract as a surrogate for buying the stock outright. So we want a lot of stock price representation. So I'm going to give you a different definition of delta as far as this is concerned. I see the video and the audio. Okay, so we don't have any audio issues, I don't think. I think we're looking good, everybody. Give me a thumbs up in that chat box if we are. Okay, so if I'm looking at this, if I'm thinking about delta, here's the different way to think of delta. That, and I'm going to point to it on the slide here, is that it represents 80% correlation to the stock price movement, right? So if I have a delta of 0.80, I look at the option contract, it says 0.80. I know that option contract represents 100 shares of stock. If I take 100, multiply that by the delta, we come up with 80. So in this situation that we're talking about, the way that I want to think about delta is that it's going to represent basically 80 shares of stock, or as I have highlighted on the slide, an 80% correlation to the stock price movement. Another way to say that is if the stock goes up 1, your option contract in theory should go up by about 80 cents. All right, so you make, if you have 100 shares of stock, you would make $1 on the stock, you'd be up $100. On the option contract, you'd have one contract, represents 100 shares, you'd be up $80. So there's many different ways to think of delta, but as far as this strategy is concerned, we think of it as the number of shares of stock that that option contract represents. Now, it's cost effective. They require less capital than the outright purchase. That is all true, but it's still an option contract. It still has an expiration date. It still has time premium. So those things we have to address. So our allocation model is we're going to look at taking 10% of the portfolio for the underlying that is chosen. So like if you have $100,000 of stock and you just chop that up into 10% increments, you could have as many as 10 stocks inside that portfolio. And we'll probably stick somewhere around that. That will probably be the test model, or the whenever we're looking at at allocations and giving out numbers of contracts that we want to buy, it's probably going to be somewhere like that. That would be basically our test portfolio that we'd be looking at. And so 10% would mean that we could buy 10 stocks. Now, 10 stocks is a lot. Most of the time, I think we'll be somewhere between 5 and 7, but we want to keep it open, right? We're going to be flexible in this. Very rarely are we only going to have 1 or 2 positions on, and sometimes we'll take some off and then let that money settle and give it a few times until we find another opportunity. So we're not going to just fill up the portfolio to fill up the portfolio, if you will. We're going to be looking for specific stocks that fit our criteria that we can put inside of that portfolio. Okay, so this strategy offers significant leverage with a reduced initial amount of capital. So what I have found from my I've been teaching options for over 30 plus years. When I'm doing this strategy and I'm talking about it with investors, if I go out about 6 months in time and I look at the price of the stock and I look at an 80 delta option contract, it's usually about 20% of the capital needed to purchase 100 shares of stock. So that's not always the case. Some big things that matter is how volatile is the underlying. If it's less volatile, then you're not paying as much implied volatility premium. So usually the option contract will be a little bit cheaper. It just kind of goes hand in hand. Once again, it's all about how you want to think about that option contract that you're buying. But typically, it's if you're going to go out 6 months in time, you're looking at an 80 delta option contract. That means you're deeper in the money. You're going to be putting up about 20% of the capital needed to purchase 100 shares of stock. So with that said, sometimes I have taught deep in the money option contracts, and I think that if you were going to buy 100 shares, this is one way that you can limit your risk. And as opposed to buying that 100 shares, let's just buy one contract. Well, we're going to use the leverage a little bit more. If we were thinking about buying 100 shares, we might buy 2 or 3 contracts. It's going to be all about the portfolio allocation as opposed to just thinking of it as on a per contract or a per share basis. All right, to give you a little feel for it. And then we're also going to look at income generation. Inside the options playbook, I actually coined the phrase fig leaf, which means that it's a leverage covered call. But the strategy, if you go to my book, which is optionsplaybook.com, and you put in the search tab, you put in fig leaf, it will say that this is an alternative to doing a covered call where you own 100 shares of stock, but the tagline is that you're kind of covered in that if the stock gets taken away and you own the stock, well, that's simple. You can just let it get taken away. You can be asleep while that happens. It's not that big of a deal. But there's a little bit more management that goes along with doing this portfolio where you own the option, you own the right to buy the stock as opposed to owning the stock. So we want to manage those positions a little bit closer. And because of that, we're going to give up some premium. We're not going to sell a nearer term option contract and try to get an exact dollar amount, right? If we're targeting options on this portfolio, we're going to go about 30 days in time. Remember, we got a 6-month option contract. So if everything went perfectly, every 30 days we would sell a new option contract. And we look for a delta that's close to 10. Now, delta is also probability. So you can say that there's about if you ride it all the way to 30 days, there's a 10% chance that that option contract will be at least 1 cent in the money, meaning that you would be assigned. So there's some reason behind that. And the fact that we go out 30 days, though, we still get something for it. The time premium, there's still something worth selling, even though it's not a 20 delta or a 25 delta. It's not a higher premium thing because we aren't paying as much as we would have if we bought the stock outright. We're paying quite a bit less, and we don't want to be assigned. And it's that simple. We're not doing this to try to get rid of it. We're trying to balance the time premium that's in the deep in the money call option and generate some income by selling calls against it. Now, the decision to sell covered calls depends on the underlying stock performance, how bullish we are, how volatile the underlying is, and we're going to look at timing. Here's a great, the last bullet here on my slide is such as whether the company is going to announce earnings or any other event that could affect the stock price movement. So in earnings season, we don't want to be assigned. We don't want to be blindsided. So we'd be less apt to sell a call around a known event as opposed to doing it when, after the earnings season is done. So we'll be paying attention to when the earnings for the company is going to be announced. Now, I mentioned stock and I mentioned volatility. For example, I'm going to pass the torch over to Tony here shortly, and he's going to talk a little bit about research. But I'm going to give you an example of a portfolio that I went through that I've already used or that I've already done. Well, I should say managed would be a better word. And one of the stocks that I had in it was Caterpillar, and the other stock is NVIDIA. So you think of those two stocks, Caterpillar had a bullish forecast on it. The stock had done very well in that time frame that I was managing that deep in the money call option. But I sold calls almost every month against that position. NVIDIA, I did not. I didn't want to manage it. I didn't want to be blindsided. There was too much news. There were too many gap openings. And so I just rode NVIDIA on the way up. And we're going to go through the example of when that happened. These are real numbers that I'm going to share with you today. And on the Caterpillar position, we sold covered calls to try to cover some of that premium. So that's the type of concept that's behind it. Even though there's going to be structure to the portfolio that we're putting together, we're also going to have considerations when we want to sell calls versus not selling calls. But if we do, this is going to be the format of the calls that we're going to be looking to sell. All right, and I do see a bunch of questions that are popping up in the Q&A box. Ideally, if you could use in the chat box, if you can use the Q&A box, that would help. That keeps us a little bit more organized. But I'll keep an eye on both of them as we go here. And I see No, the man that does not need any introduction, Tony Zhang, popped up here on the screen. And at this point in time, I guess, Tony, I'll stop sharing my screen. Uh, and there you go. You already took it away. It's all
Thank
you.
you so much. Thank you so much, Brian. And thank you so much for joining us, everyone, this afternoon. As you have heard at this point, we'll be launching this new uh, aspect of the daily play portfolio where we're going to be focusing on more longer term option strategies that align with the research that we continue to put out here. Over the past few months, we've been publishing the Monday and Thursday research report. This is going to be further, I would say, enhanced with the long-term stock outperformance strategy that Brian just laid out here. And the strategies that will be, or the symbols that we'll be trading these long-term strategies on will be based on the stocks in our research portfolio. So what I want to do is spend a couple of minutes on walking you through this research report, helping you understand how we come up with the ideas so that when you're looking at these ideas on Monday and Thursdays when they come out, you have a clear understanding as to what we're looking for, why we are selecting these specific stocks, so that when Brian sends out a trading signal to buy one of these deep in the money call options or sell a call option against that, you have already, hopefully at that point, done the research of the underlying shares, and you will be comfortable enough to execute those trades. You don't have to learn about that stock that morning to figure out whether or not you want to trade it. The goal of these research reports is to give you plenty of time to understand why we have a bullish thesis on a specific stock and how we're going to play it utilizing options. So one of the things that we do every single Monday and Thursday is give you a list of the stocks that we have the most bullish views on in the markets right now. And what you have are a list of stocks that we have that we maintain a bullish view on. And what you at the beginning of the report, you're always going to see a list of all the current stocks in our portfolio, whether we're bullish or bearish on it, and when we first added that symbol to our portfolio. So as you can see, some of the names that we added earliest, like such as Shopify, Lululemon, Square, and Disney, these are some of the ones that are up a fairly significant percentage. And you look at Shopify up 61%, you look at Square, Lulu, and Disney, that's up 20, 30%. This is really where when we utilize these deep in the money call options and leverage our capital about 5 to 1, you're going to see instead of 20, 30% returns, you're going to be looking at 100, 150% returns on the same move, especially if we're able to sell some calls against it and offset, excuse me, some of the time decay on the options themselves. The goal is to be able to amplify the research report ideas from these 20, 30% moves in the underlying into 100, 150, and sometimes even substantially more than that, such as the example that Brian will show you with NVIDIA here in a couple of minutes. But these research reports that we send out, and what I'll do is I'll use NVIDIA just as an example to walk you through. What you have is going to be a underlying chart for where the stock is currently performing, and then what we do is we give you a breakdown of why we like the stock from a timing perspective, meaning from a technical perspective, and why we like the stock from a fundamental perspective. And we always break down 4 key fundamental metrics that I use at the core of my analysis to better understand whether a stock is undervalued or overvalued. And you're always going to see the same 4 metrics every single time, so that when you look at this, when you're looking at a new idea that we print out here, you're always going to get a consistent understanding as to whether or not you agree with our underlying research. So generally speaking, these trades fall into 3 different categories. They can either be trend following, they could be counter trend, or they could be outperform. Effectively, what we're doing is we're either trying to capture a continuation of an overall trend, or either trying to capture very early beginning of a trend, or we're looking at a stock that is simply just outperforming those momentum stocks that have the opportunity to really take off, like we've seen with Shopify and Disney and Square over the past few months. So what you're going to get is an understanding of what type of strategy or what type of scan does this specific stock meet. You're going to give you a quick overview of the technical levels that we're paying attention to, what are important support and resistance levels, what are our specific targets on a specific stock, and then more importantly, I always think that there are thousands of stocks that you can scan from a technical perspective, but once you dive into a specific stock, once you look at the fundamentals, you can screen away probably 90 to 95% of the symbols that come up. And that's the part that actually takes a lot of time because the fundamental part is hard to do algorithmically. It takes a lot of manual time to actually go through the fundamentals, understand a company, understand how they make their money, and then look at the valuations. What we expect the company to grow, how fast do we expect that company to grow, how profitable are they, and those are the primary metrics that go into understanding the valuation of that stock. And what we try to compare is the valuation of that specific stock to its industry and whether it's trading at a premium or discount and whether it should be trading at a premium or discount relative to that. So we always break that down to you. So looking at NVIDIA, I think we're all very clear as to what NVIDIA does and what the specific outlook here for NVIDIA is with regards to their manufacturing of AI related chips. We do expect demand for these chips to remain incredibly strong here over the next couple of years, which is why you have the first fundamental thesis for NVIDIA. But then if you look at the fundamentals here, right, even a couple of quarters ago, this was the stock trading at 40, 50 times forward earnings, which is hard to grasp, your arms around as to whether or not it's worth continuing to pay those types of valuations for. But over the past couple of months, the stock hasn't really moved much, right? So if you look at this back in June, the stock was at 140. It's now trading at 145 now. So basically, in the span of nearly 6 months, the stock hasn't moved much. It's been choppy and it's consolidated a little bit. But since then, revenues and sales have grown substantially. So what that means is that we're trading at a much reasonable valuation here. We're trading at 32 times forward earnings, which is still a 50% premium to the industry, which is expensive. But if you look at how fast is this expected to grow, 64% EPS growth versus the industry average is 13%. So you're talking about 5 times faster EPS growth. Revenue growth is expected to be about 8 times faster than the industry. So, and if you look at profitability, the average net margins in the industry is about 20%. Nvidia is at 56%. So, we're talking about leaps and bounds more profitable. And actually the net margin, metric, I think is actually a bigger driver of valuation than growth. So when you put all this together, the fact that it only trades at a 50% premium relative to its industry, from my perspective, is incredibly cheap. And that's why I think that even though it's trading at a high valuation, there is still plenty of upside, especially now you've seen this consolidation. You've seen the breakout here above 135. It's now retested this level twice as support, confirming that support level is holding. And this is really where the upside opportunity lies. So that's an example of the trade structure that we will lay out for every single trade idea that we post. I'll give you one more trade idea just to show you kind of what we've done here. Alphabet was one that we added here today as well. Very similar to NVIDIA. Basically, this stock, if you look at this over the past nearly 9 months, has really not moved, right? This was a $170 stock 9 months ago. Back here in April, it's still a $170 stock now. But economics for this particular company has changed quite a bit. And now the fact that it's trading at only 19 times forward earnings, even though it's expected to grow EPS and revenue faster than its industry, and it's far more profitable than its industry, yet it trades at a slight discount to its industry. That's really where the opportunity lies from a fundamental perspective. And then you look at it from a technical perspective, the chart layout is very similar to NVIDIA. 170 has been this is 167.5 has been a resistance level. We broke out above it, came back to retest this as support, and now we're bouncing off of it. So at the very least, what I'm shooting for is an upside around 192, but I think the upside potential here is actually looking at it well beyond 192, especially if you look at it from a valuation perspective. I think this should probably be trading at least 23, 24 times forward earnings rather than the 19.5 that it's trading here right now. And that would imply a breakout here well above those all-time highs. So these are the types of opportunities that we're presenting to you where the technicals and fundamentals align. We will tell you kind of where we are bullish on the specific stock, and we will also maintain a list for you to show you when we are bullish, how long we've been bullish on the specific stock, and we'll continue to update you on a specific stock until we are no longer bullish or bearish on that specific stock. And that is what Brian's going to be pulling from when he presents these deep in the money call options to help amplify the returns that you're seeing on this particular screen, hopefully from 30-40% returns on the underlying into well over 100% gains on the underlying by trading a leverage portfolio using a deep in the money call option that still provides downside protection to the downside. So with that, what I'll do is I'll hand it back to Brian to help you walk through a real example that he has had for both NVIDIA and Caterpillar using this specific strategy.
All right, here we go. And it's back to me, my screen?
Yep, you can just go and share your screen again.
Oh, that's okay. 1 second, let me get there. I don't know what happened to my PowerPoint. All right, let me get there. 1 second. Come on. Huh. All right, I got it, guys. I got it. I'm back. Had to go through a couple of things. But I do want to, before I get too far into this strategy, we're talking about NVIDIA. NVIDIA has obviously been a very good stock. So I don't want to say that I cherry picked this one strategy. The main reason why I want to go through the NVIDIA strategy is that something happened, and that we actually see some movement and see some adjustments that were made in a fairly short time period. So with that said, I am back, and I am going to share that. And I think I am back and good to go. Can I get a thumbs up? Yeah. You see my screen now, right, Laura? Yeah, there we go. Okay. So here's my example. And this is a real example that was used, that I actually was managing a portfolio in NVIDIA. And it's just really straightforward. It's not the exact same criteria that we're going to be using. We're going to have a little bit more, just a little bit more rules behind what we're planning to do with the stock outperformer. But here's the initial purchases. Going all the way back to 2023. Now, this is prior to the split in NVIDIA. On the 18th of October, which was a volatile month, decided to buy one option contract, a deep in the money option contract. NVIDIA was trading at 424, and we bought one January 17th, 2025 option contract at that point in time, and that was 457 days to expiration. We're probably not going to go out as far with some of the option contracts that we'll be trading, and part of the reason why is that we're going to be managing the position a little bit more. Okay, so here's where the time value was in that option contract, and we do want to make note of that. We're going out way far in time, but we want to know how much time premium we're paying, especially if we're going to try to sell some calls against that position as we go. Delta was 78, market value was $15,500 to buy that one option contract. Let that ride, got through the October time period, one of the more volatile time periods in the month, and then we came back and bought 2 more NVIDIA, the same strike calls. At this point in time, there's 403 days remaining. The time value now is $36 in that option contract. Here's the delta and here's the market value. So bottom line is this was 25% of the $200,000 portfolio. There were other positions that were in. It was a time period where the market was strong to the upside, so almost a lot of the positions did well, but NVIDIA obviously stood out because we're heading right into that stock split. So all that said, market's going up. Here's what we did. Next, NVIDIA is about to announce earnings. It's February 21st now, 2024. NVIDIA now has jumped to $681.45. The decision on my end was to sell one call option. It was becoming a big part of the portfolio, and we had the nervousness that was going into the earnings. So we ended up selling one of the 380 calls, and then we're going to keep the other two riding into the earnings. So 331 days, we actually just brought in capital to try to make it so it wasn't such a big part of the portfolio and capitalize in some of the gains. Okay. NVIDIA announces earnings, the stock does well. Now, this is where the stock outperformer, where we're going to be using this strategy a little, or this concept a little bit more as we go forward. So what did we do with this position? And notice, I should point out here that the delta is approaching 1. And that's going to be an important thing as far as the portfolio is concerned. You want to get the leverage. And once you get to 1, you're extremely deep in the money. A couple of things happen. You get wider bid-ask spreads on the option contracts. They're not traded as heavily. And we're getting something that's going to act a lot like the stock. And here's one of the beautiful things, and I should emphasize this, about buying deep in the money options is as they go deeper in the money, you get more and more delta. You pick up more shares of stock. Like I was saying when we first started the presentation, I like to think of it in this strategy as stock price representation. So at this point in time, we started with an 80 delta. We're now got a 96 delta, or we could say we started with 80 shares and now we got 96 shares. But once you start getting deeper and deeper in the money, bid-ask spreads widen. I like to roll at that point in time. So that's what we did. So we got out of this position, brought in some capital, rang the cha-ching, and now we're looking to roll the next position because before we know it, after the stock was at 681, after the earnings, they blew the market away, and we're getting closer and closer to when they're going to announce their split. Stock is at 900. Now, this is more common in what we're going to do. We're now at 296 days to expiration. So we're going to go back out. And in our concept, we'd probably be, let's say we started with 6 months, went down to 3 months. Now we're going to roll back out to the same time period. So in this instance, we went out to 450 days. We sold 2 of the NVIDIA calls. We sold to close 2 of them and bought to open, once again, an 80 delta. Taking some of the money off the table, we can allocate it to a different stock if we'd like, but we still want to rebalance our portfolio so we're not too heavily weighted in the NVIDIA position. And on top of it, we don't want all the risk of being in this one option contract and have it such a huge chunk of our portfolio. So in this instance, we buy 2 NVIDIA to open, 700 strike calls now. So we've gone up quite a bit as far as our call strike is concerned. We've gone out in time, took some money off the table, put the value back to $64,200. But now the portfolio, because it's not just NVIDIA, but the portfolio went from 200,000 in that time frame up to 330,000. Market value of the position now is 64,000, back to about 20% of the total portfolio value. In our world, that's probably going to be coming back to about 10%. All right. Next, let's see what happened. So here's the purchases and here's the sales. On 10/18, we made a purchase of $15,500. On 12/11/23, we made a purchase of $35,610. That means a total purchase of $51,116. Ultimately, that was about 25% of the portfolio. And then we came out and we had a couple of sales. We sold one option contract, brought in $38,000, and then we rolled some option contracts and brought in $119,000 on that roll. Net credit of $157,280. Okay, don't spend too much time looking at the numbers. Like I said, I feel guilty sometimes talking about this one trade because it obviously outperformed the market, but it's more so about the maintaining of that position. So if we look at the sales, we still want to be in NVIDIA. So with that capital that we brought in, we paid 51 grand, we brought in 157 grand, we have 106,000 net credit. We're still going to make a new purchase. So we go all the way back to the 64,000, we bring the portfolio back down to that allocation that we wanted, right around 20% at this point in time when I was managing this portfolio. And boom, now we have a new position. We're long 2 NVIDIA, June 6, 2025, 700 calls at $321. Our delta goes back to 80, 450 days to expiration. Turns out that that's 19% of the portfolio. And right now, just on that NVIDIA position, we had a $41,000 gain, which is the difference between, I'm going to jump back one more slide, difference between that and the new purchase. And that ends up with 41,000. And we still have the 2 option contracts. And as long as our outlook on NVIDIA hasn't changed, you would still be in that position looking at that trade. But that's the outlook on the way up. Now, I'm not going to take the time to go through an example on the way down, but here's what's up. If we do have stocks that are going down and our outlook on the underlying changes, there are 2 simple rules to me. And I'm going to use this example here to try to just kind of talk about it. I talked about how we pick up deltas on the upside, and that's a wonderful thing about deep in the money calls. As the stock goes up, you gain more and more shares of stock because you gain more and more deltas. Well, as the stock goes down, you lose shares of stock. In other words, it doesn't go down as hard as it does on the way up. So if an option contract eventually becomes an at-the-money option contract, guess what delta becomes? It goes from 80 down to about 50. So you lose less on the downside. Now you still got time decay, right? You still got theta, you still got issues that you got to deal with in an options price that you don't have to deal with the stock. But if the stock ever comes down to the 700 strike, we're going to get out. First of all, our forecast has probably changed, and you're going to be selling an at-the-money option contract. You'll be selling the juice of that at-the-money option contract. We're going to add in some other things to go along with this, though. Like, we'll be concentrating on price. We'll be looking at the chart of the underlying. We'll be looking at the fundamentals of the company. Somebody brought up the fact that in a 6-month time period, there's going to be a couple of earnings reports. We're going to be aware of that, without a doubt. So that will affect what we do with our positions. But I never want the stock to go below that strike. I want the benefit of selling an at-the-money option contract and getting all that time premium on the downside. So that's some of the protectionism that's going to be inside this trade. And just by itself, the fact that you are paying less than buying the stock outright. And we're going to come up with a leverage model as to how many option contracts that we want to trade relative to buying 100 shares of stock. But that's it. That's basically where we go. And so with that said, I'm going to bring up the slide. You got the free trial right here, 30-day free trial. Just hit that QR code, go to optionsplay.com/signup, and that would be available to you. And I see a boatload of questions and a boatload of people in this event, so let's get to them. If I look at these positions and I look at these questions, I'm going to try to sort through a few of them. And I think Tony's going to come back and we'll try to address them. Some of the things that I saw earlier, somebody was talking about, why don't I just buy a deep in the money SPY option contract? And I don't remember that, but it popped up in the chat box, and maybe sell some 6-month calls against it. That's an interesting alternative, especially if you're just looking at if you're not up for a higher risk, higher potential reward and downside. I'm not going to joke here that you obviously have downside risk if you're going to do this. But if you are thinking about buying an ETF that tracks the S&P 500 index, well, why not think about buying the SPYs? And better yet, maybe we just buy a deep in the money option contract. If the stock gets to 1, then we roll it out further in time and we roll it up in strike and go back to 80. Yeah, so the same lessons that we're going to apply to our portfolio can be applied to a strategy just in the SPY. And from time to time, we might do that. Recently, we bought a deep in the money call option in the QQQ. That was one of the daily plays that we did. And mainly that was because we were going to ride the euphoria of what has happened after the election. It just was that simple. So there you go. Yeah, I don't disagree with that. This is just going to be a more active portfolio, and hopefully we will outperform when we're looking at these trades. Okay, so now I see that. And Tony,
Hey,
are you with me?
Brian.
Yep.
Yep,
Okay.
I'm back. I'll answer a couple of questions that were directed at me, if you don't mind.
Yeah, no problem.
Ming Hua is asking, Tony always preaches to invest no more than 1 to 2% per trade, up to 4% for a small account. The 10% that you were suggesting is a big deviation from that. Is that okay? That's a great question here. So the 1 to 2% rule is still going to apply when you're trading speculative strategies. So if you're buying a debit spread, a credit spread, those types of strategies, short-term swing trades, we generally do not recommend risking more than 1 to 2% of your account per trade. But these are stock replacement strategies. So this is really think about your long-term investment portfolio where you typically buy stocks, and you would risk probably somewhere in the 5 to 10% range of your entire portfolio per stock. And this is really why we are going up to 10% in a portfolio for this, because this is not really, the same as a speculative option strategy where, your chances of losing 100% of your premium is relatively high. Here, as a stock replacement strategy, your chances of losing 100% of the premium that you're paying is much lower, which is why we are going to risk up to 10% of your entire portfolio for this. It's a great question.
All right, then I'll take one, Tony, and then I'll let you cherry pick another one. How about that? Uh,
Sure.
Emmanuel says, if you're bullish on the stock and you can buy a deep in the money call, can you also sell a put? That's more of a wheel strategy, and that would be based around the stock because that's implying that you want to buy the underlying stock if it goes down. So that won't be a part of this portfolio. By buying the call option and using the leverage of the call option, the synthetic relationship to buying a call is a protective put, where you buy the stock and you buy a put, limiting your downside, and you pay for that put. So we're using some of the same concepts, but we're not trying to buy the stock. And so on the downside, we're not going to be selling that put. I guess that was a long-winded answer to something that could have been a little bit shorter. And then I'll do one more here, Tony, and then I'll let you jump in. Does a broker consider the covered call you have on a deep in the money option and don't actually own the underlying stock? Yeah, and that's the tricky part about the strategy, Jeff. And I think I kind of covered that a little bit. But we don't want to be assigned if we sell the call. So we're going to have to manage that call position. And that's part of the reason why we're going 30 days out and doing a 10 delta. We want the probability of it getting assigned to be low. So they do consider it covered, but this is why I came up with the strategy. And I'll show you those, and I'll pull up my book and I'll highlight that section. That's why I call it the fig leaf, because you're kind of covered. You don't own the shares, but you own something that allows you to buy the shares, and it acts a lot like the stock. But if you get assigned, you need to do something, and we're going to manage that, and we'll talk through those things. That's a topic for a different day. And I'll go back to you, Tone.
I see a bunch of questions about poor man cover call and why not calling it a poor man cover call. For all intensive purposes, this is a poor man cover call. Whenever you're buying a longer dated call and selling a short dated call against it, technically that's a calendar. But what we're doing, because it's a deep in the money call option you're using as a stock replacement strategy, this is effectively a poor man's cover call. So I saw a lot of questions about that. Hopefully that answered your question there. I also saw quite a few questions regarding the loft report and how to get access to that. If you have either a free trial to OptionsPlay or if you have a paid subscription to OptionsPlay, we send that out to you every single Monday and Wednesday morning. And I host a webinar every single Monday morning, which is publicly available to everyone going forward, where you can watch where you can come on Monday morning and I walk you through every single stock that we have in our buy list so that you have a clear understanding as to why we have a bullish or bearish thesis on a specific stock, so that you have your research done before the week starts, so that if Brian sends out any trade ideas for that week on any stock in that list, you are prepared for it. So either have a free trial, so using the QR code that we just had on our screen, or if you have a paid membership, you will get access to it every single Monday and Thursday. And please join us every single Monday morning. I give you a quick rundown of the market and walk you through all of the trade ideas one by one.
All right. Do you avoid earning events with 6-month options? We don't avoid Greg asked this one. I just jumped in, Tony. I don't know. Did I bogart you there? I mean, you didn't have another question. All right, I'll just run with it. So Greg asked, do you avoid earnings with 6-month options? We're not going to avoid their earnings as far as the company is concerned, because the fundamentals are going to matter. And so we've done the research on the fundamentals. We're assuming the earnings are going to go along with that, but we will avoid it on the short option contract. We just don't want that volatility. We don't want to get blindsided and be assigned. It's going to be hit and miss, but there's going to be a lot of subjectivity into when we want to do a covered call position. Once again, implied volatility. I gave you the example of Caterpillar and NVIDIA. Did covered calls on Caterpillar, but not on NVIDIA, just because totally different forecasts between the two different stocks. All right. And I'll grab one more. Tony always preaches. All right. That's the one. John, will these daily plays be listed, updated daily as we hold the options? Also, the covered calls will be listed and will be part of rolled or closed. Yes, John, in general. John is asking, in the daily plays, which are now a little bit more speculative, they're a little bit more, here and now, as short as I've done a couple of daily plays that around earnings that have been one day, but normally they're anywhere from 10 to 30 to 45 days out. These will also be updated. They'll be a part of the daily play scenario, and they will be monitored. You will be able to see them inside the daily play portfolio stocks. We're debating if we're going to put up another portfolio instead of combining the two, because they're such different strategies, but you will be able to see them if you are on the OptionsPlay platform and you sign up for the free trial or become a member. All right.
I'll try to answer a couple of more questions and then I have to run.
Okay.
So, one question saying you can use deep in the money call options if you're bullish, but with the loft report, how do you take advantage if you feel the stock is bearish? So we will likely not be trading any bearish trades with this type of long-term strategy. This long-term strategy, like I said, is a stock replacement strategy. This is really thinking about long-term investments in your portfolio. So we're only going to be looking at the bullish setups for this specific strategy out of the symbols that we have in our loft report. What option level approval do you need for this trade? You typically need level 2 or 3, which is whatever depending on your broker, spreads is going to be what you're going to be required to be able to do. So anytime when you're able to, if you're able to trade a debit spread or a credit spread, you will be able to trade a calendar spread like the one that we have here. And with that, Brian, I will pass that back to you. I do have to run. Thank you so much, everyone, for taking the time out here today. And I will leave you guys in the great hands of Brian Overby.
All right, Tony. Talk to you soon.
Thanks. Thank you so much.
All right. Stop sharing and let's share the right one this time. I'm going to share with you optionsplaybook.com, which I am the author and the owner of the website. And this is going to be some required reading. If you're thinking about joining and you want to go deeper into this strategy, there we go. I got it right. Inside optionsplaybook.com, if you go and you check out the fig leaf strategy, and once again, there's other names for it. Diagonal would be a name. And literally, the term diagonal comes from the fact that you're buying one option contract that's deeper in the money and you're selling one that's further out. And if you were standing on the trading floor, in order for the market maker to quote the strategy, they would have to look diagonally on the board. And so that's where that comes from. That's one of the names. But I do like the name Fig Leaf. That it has kind of taken off a little bit. And if you go and read a little bit about the options tips and everything that go around it, once again, it's a strategy that's very popular that never had a name. And here's a little bit more detail: buying leap calls as a substitute for the stock. And probably the most important one is rolling a covered call when we want to roll. Because if you're doing this strategy, and if you're doing it on your own, I mean, we're not saying that you have to do exactly what we're doing. If you learn and you can implement it by yourself, that's a whole part of options play. You want to know about rolling covered calls. You want to know when you want to do it. You don't want them to get too deep into money. So these are three little required reading, I guess, if you really want to go down the road of learning how to do the stock outperformer strategy. And with that said, yeah, we're there, aren't we? We're almost at the 1 hour. I'll answer a few more questions and then we'll call it a day. I'll see a big one here from Bob. If you're buying deep in the money calls, why not sell long-term option leaps that over 365 days? Yeah, Bob, you can. And that is, there's more management and there's less management. If we did that, Bob, we wouldn't have a daily play, right? We would just put out one position and come back a year later and be like, oh, did we hit our strike on our short option or did we not? So this is a more active strategy, and you're hoping to outperform something where you would do that, something where you would go that much further out in time. But that's not a bad strategy. I'm all right with it. Time decay on those longer term option contracts, to be selling them, there's some good and bad there. You can go much further out of the money, but you're obviously not in the heart of the curve as far as time decay is concerned. 30 days is good in my mind. Where you really start seeing the theta decay kick in or the time decay kick in is in the last couple of weeks. So sell the 30-day. Hopefully you don't get up there in time and take some advantage of that huge rate of time decay in the last couple of weeks. All right, Brian, what strategy is the call risk reversal? What strategy? Well, you just call risk reversal. Well, that is synthetically going long the stock. Okay, I think that's what we're going with here, Rick. You're asking about a risk reversal. If you buy a long call and you sell a short put, and you do it with the same strike, you are basically saying, I have the right to buy the stock at that strike, and I'll take on the obligation to have the stock put to me at that strike. And if you're looking at that, that's a synthetically long stock. And you can do it the other way and get synthetically short stock. And I think that's what you're talking about, but that's not really applying here too much. All right, and then why not use 20 delta and roll if it gets close? You can do that, Barry. You just it's going to be a lot more management. Why not use the 20 delta, get more premium, and roll if it's close? I would do that more so on a stock strategy. I would do that if I owned 100 shares of stock, that would probably be the option contract I would be looking at. We don't want to roll. I don't want to... I want to avoid the roll, and by going further out and looking at 10 delta, there's a little bit less probability of that happening. And on top of it, you don't own the stock. You didn't pay as much money for the stock. So it's okay to get a little bit less premium because you didn't pay as much premium, right, to buy the stock outright. So that's where we're at. A long grind down. How do you manage a long grind down? You get out. You just do. You got to be able to say, I don't want any more. I've had over the years, I've had a lot of people come up to me and say, I bought this option contract and now there's no bid ask on it. What do I do now? And I'm like, well, you just drove your car off the cliff and took it to the shop and asked the mechanic, how do you fix it? There's just no fixing it. So just manage it. And one of the general rules, I don't want it to go beyond my strike. I want to be able to sell an at the money option contract, but we'll also have an outlook on the stock and an outlook on the option, right? If I put this trade on and we're losing half of the value of the option contract, well, we're going to consider getting out. But that's not going to necessarily be the rule. We'll have a more defined rule as far as what price we would want to get out on the option contract. If the stock goes down, our hedge is to get out, Jonathan. And I think everybody's kind of asking that same question. One of the beautiful things about the option, though, is as it goes down, delta gets smaller. It goes against you less aggressively than if you own the stock. You lose shares of stock on the way down. So once again, the one thing that I would like is if it gets to my strike, I'm not going beyond that, right? If I got the 700 delta call in my final position on Nvidia, if you go back and look at those slides and it gets down to 700, that was prior to the split, then I'm going to sell it and get out. Take advantage of that at the money time premium. All right, everyone, I think that's it. I know there's a few questions coming in, but a lot of them are reinforcing things on the downside, and we put our hour in here. So excited to introduce this. Have done this on an often basis with retail customers and in my own portfolio. So it's going to be kind of fun to be able to put this together and make it a more official way to trade. And realize that you're not going. This isn't execute when I do strategy, right? This isn't a newsletter. What I'm trying to say is we're going to talk about the trades. We'll be talking about them usually overnight. Sometimes we might do something during the day, but we're not going to send out an alert so you need to buy it right now. The strategy is more so we like the stock. If you buy it this afternoon, okay, you might pay a dime or maybe a quarter more for that option contract, but it's not that type of strategy. Does that make sense? Just want to emphasize that. All right, William, we'll do that. Downside rules, well, the biggest one, William, is that we're not going to let it go below the strike. If the strike is 700, it's not going to go below that strike. Oh, do we follow you? Oh, if you want to follow me, my X handle is at my name, at Brian Overby. My website, I own Options Playbook, and I also work with Options Play. So Options Playbook is a book that I've written many years ago, and it's still #1 on Amazon as far as option trading books. It's always in the top 10 list. Thank you, everybody. Thank you. All right. With that said, that's it for this edition, for this kickoff event. Fittingly, I am a Packers fan, just so you know, and they're playing Detroit tonight, so go Packers. And this will be the official kickoff of the Stock Outperformer. Thanks for coming, everyone, and hopefully we'll see you inside the Options Play platform.